All right, well, we might get going. Well, good morning, everybody, and a very warm welcome to you this morning. My name is Jenny Wilcock, and along with Terry Dewing and our fabulous team, we run Sullivan Dewing, Chartered Accountants and Business Builders based in Caringbah. Today, we are hosting our annual economic update via Zoom, and we've just got the slides coming up now. That's fabulous to see. We have our two very special panelists joining us this morning. We have Stuart Carey from the CBA, and thank you, Stuart, for supporting us in this event for many years now. And we welcome, of course, Craig James from CommSec. And thank you, Craig. We are very much looking forward to your economic insight today. So before we start, a little bit of housekeeping for everybody. If you have any questions, if you don't mind typing those into the chat box, and we'll answer those at the end of the webinar. If there's any questions that haven't been answered, we will come back to you after the webinar and let you know what you need to know. So you have received the presentation slides this morning. They've been emailed out by Jen Palmer. Thank you, Jen. And at the end of the webinar, we will shoot you out a recording. So here we are again, already heavily into another financial year. It's mid-August, and the time has just been flying, absolutely. So it's been crazy times with COVID, crazy times for us here, and I'm sure crazy times for you there. There is no doubt. So we've had a number of you attend our economic update in past years, and we certainly thank Craig for supporting us for many years. And in fact, this is our 10-year anniversary, Craig. Happy anniversary. So thank you to both of you for supporting Sullivan Dewing and our clients for this time. It's been fabulous. And I must say, certainly now we need you more than ever. So we are very much looking forward to some insights from you this morning. So to formally introduce Craig James is CommSec's Chief Economist with a vision to present CommSec's research in a user-friendly way. Craig is a regular on TV, radio and newspaper, so he's right at home for us today. He interviews, he regularly commentates, as well as presenting to staff, to clients and to external organisations. And we are absolutely very, very fortunate to have Craig joining us today. Let's welcome Craig and pass over to you. Thank you.
Well, thank you very much. It's good to be here virtually, this year rather than, in person. In previous years, some of you may remember, so I talk about my old 91 Falcon getting down there. Well, of course, that's gone the way of the dinosaur, and now I don't need to use 91 Falcons at all. Now we can use technology such as Zoom. So certainly, there can be ifs and buts with, the technology. Sometimes it can fall out and, connections and the like. So certainly, if something goes wrong through the presentation today, I hopefully, Jennifer Palmer and Jenny Wilcox can let me know, so that I'm no longer broadcasting. I'm talking to myself in a box here. That's always, the strange thing with this, that you can't get to see anyone, and you can't get to really, hear anyone too, so the connection falls out. I think the thing that I have to say right at the very start, there's the thing that's required for economists to say is that we live in extraordinary times, and that's really not saying too much. So everyone, is well aware of what the impact has been on their own personal life as well as their business life. If there's any positive that's come out of this situation, is that we're learning different things. We're learning a different way of working, a different way of living. And indeed, so when we're confronted with those sorts of things, they can be quite positive. So in terms of the presentation today, I'm looking at my watch here. We're just after 9 o'clock. Hopefully, if all goes well, so we'll be talking for around about 30 odd minutes, a bit more. You've got a copy of the presentation, so that's all well and good. And if you've got a copy of the presentation, you've got this slide, which is the disclaimer slide, which indicates that I haven't whipped around, Sydney. I don't know your own personal circumstances, so this is very much of a general nature. In terms of today, well, I think one of the other extraordinary things that's come out of this period, time, is the fact that there is so much more additional information and research that's being done about, how we're all going through this period, the impact on businesses, the impact on employment, so the impact on people's, personal lives, as well. The Bureau of Statistics has provided a lot more research. Our own Commonwealth Bank this morning put out some weekly data on card spending, so credit and debit card spending, and it actually shows that spending nationwide is up 4% compared with a year ago. Of course, that includes Victoria. If you look at Queensland, it's up 20%. If you look at Western Australia, it's up in the order of 15%. I'll refer to a number of other bits of research through today. So the CommBank researchers at commbankresearch.com.au. You know our own CommSec research, so you can go to the websites there and get any information. There's been a report put out by Xero and the demographic group, Bernard Saltz, the demographer, Rebuilding Australia. That's a worthwhile thing to look through, particularly in terms of the impact of COVID on small and medium-sized businesses. And there's another small and medium-sized enterprise tracker from ACA Research. Certainly right at the outset, so we do know that what we're going to see is some amazing statistics, sort of in coming months. We've already seen some amazing statistics on things like unemployment and retail trade, and we're going to see some amazing, sort of changes in the Australian economy, contraction in terms of the June quarter and the September quarter, and before hopefully a rebound, so later in the year. In terms of our debt levels, likely to get up to around about 45% of GDP, or 850 sort of billion. We've had deflation, annual deflation for the first time in 89 years. We've got a budget deficit next year, or this current year that we're in, heading for something like 10% sort of GDP. So these are amazing times in terms of the figures that we're dealing with. So let's get into it, sort of more properly now, and let's have a look at the state of play. If we went back to January, February, you'd have to say that there was a bit of optimism, because it looked like the US-China trade deal was finally going to get across the line. It also looked like Brexit was going to get done as well. But then COVID-19 came across. It basically started its life in Wuhan in late December of last year. And then, given globalization, given the amount that we travel nowadays, it has spread, sort of right the way across the economy and continues to rise. Countries, when confronted with that, sort of have taken on different sorts of approaches, but most have taken a view that, they needed to go into lockdown period for a period of time, close down businesses, get people, sort of back from back home rather than in their workplace, and give a period of time for things to settle down. So therefore, the health system could, sort of absorb the pandemic, so as we moved out of lockdown. Interest rates have been cut right the way across the globe. So now a common rate is anything between 0.25% of 1%. We're seeing government spending money in a big way. And this is in sharp contrast to if we go back to the Depression of the late 20s, early 30s. At that point in time, the view was that you actually got a problem in terms of your budget situation. You have to cut back on spending to be able to balance the budget. So fortunately, yes, we've made the good decisions here this time around. We're certainly seeing a global recession, but the big question is, what form is it going to take? Is it going to be a V-shaped recovery where we're going to really just bounce out of it? Or is it going to be W-shaped where we're going to go back into a downturn and before we start to pick up again? Is it U-shape or L-shape? So all the letters of the alphabet are going to be utilised, I think, as we work our way out of this one. And really, when we say, look, when do we go back to normal? We go back to normal once we've contained the virus, once a vaccine comes through. And with so many businesses developing a vaccine, sort of that's very, very encouraging, sort of where we're at the moment. Here gives you an idea about the sorts of forecasts that we're looking for in terms of this year and next year. You can see these are the forecasts from the International Monetary Fund. You can see our own Commonwealth Bank forecasts out there as well. And these are crazy sorts of numbers when we're talking about a 5% downturn in terms of the economy and a 5% upturn, so next year. So you can see that the expectation of the expectation of analysts like the International Monetary Fund is that we'll have a V-shaped recovery. But as we know, as we've moved out of lockdown, a number of countries, a number of states in the United States have had to go back into lockdown for a period of time, at least a partial. Even in New Zealand has had to face the same situation. So we're still feeling our way through this. the last pandemic was 100 years ago, or the last pandemic on this sort of scale was 100 years ago. Unfortunately, they didn't leave us with any playbook about, sort of the best way out of this. And of course, these are decidedly different times because the world is much more interconnected than it was back, sort of in 1917, 1918. You can see the global financial crisis in terms of that chart back in 2009. And this downturn, sort of puts that contraction into significance. That we've got something, sort of more approaching what we've had after the two wars, First World War or Second World War or the Great Depression. As I said right at the start, the governments have thrown a lot of money at this situation. You can see the fiscal response by governments. And you can see Australia's stimulus. I'll say I've got another couple of charts which highlight this down the track, but it just highlights the fact that the JobKeeper has been a fundamental component in terms of our overall fiscal sort of response. What about Australia? Well, the encouraging thing about the government here in Australia is that we've acted very, very quickly. The first package came into place on the 12th of March. Then we had the Reserve Bank package on the 19th, the 22nd where we spent $66 billion. And then the third package, which was initially sort of put at $130 billion, and that's ebbed and flowed over time. But that JobKeeper package was in the March the 30th measure. Now, like other parts of the world, we've locked down the economy and aim to support the vulnerable, particularly so the aged and those people so on fixed incomes with a degree of special sort of payments. The aim has been to keep business in business and to keep people employed. And I think really the measures have been very, very successful in doing that so here in Australia. Certainly businesses are still very much concerned about so where we go to from here. But no one can complain too much about the federal government and the state and territory governments about what they've done. The measures have been very, very much targeted at individual states, territories, industries, and individuals and businesses. So it's been encouraging that way. It haven't just relied on fiscal policy. We've had monetary policy in there as well. And you can see that there's a whole range of measures that have been applied. Access to superannuation certainly has been sort of one that's been quite one of the remarkable things. $33 billion has been advanced to people in terms of their superannuation. 2.7 million Aussies have taken advantage of it. And if you look at the Sydney Morning Herald website or get a copy of the Sydney Morning Herald, they go into detail about how that money is being spent at the moment. And it's not all being spent in very, very useful ways. You can see that things like liquor and gambling are getting a run in sort of the numbers in terms of how people have used their superannuation sort of money. You can see a couple of charts there putting into degree of refresh about how the economy has fared over the long term in Australia. And you can see that we are back to the post-war regions of the First and the Second World War, and as well as the Great Depression in terms of the economy. And the federal budget certainly sort of we're seeing something that so we haven't seen in terms of a budget deficit ratio since during the war and the after war period of time. You can see after the war though, that once that the war ended and we were getting back to normal, the budget sort of bounced back very, very quickly. And that is the hope this time around, that the measures have been targeted and temporary sort of measures. And as long as those measures are not required in the future, they will be taken away. And hopefully the economy will be recovering at that point in time. We can sort of get back to smaller deficits and perhaps back into surplus. A lot of money has been advanced. We had estimate $313 billion from the federal government. It's gone to a whole range of different sectors. As I said beforehand, it hasn't just gone to in the JobKeeper or the Job Seeker package. It's gone to businesses in terms of business boosting cash flow. It's gone to health. It's gone to the aviation and also regional sort of tourism sector as well. So a lot of money has been spent, not just by the federal government, but also by state and territory governments. And speaking to Jenny beforehand, she certainly has been running hard to keep up with so the measures that have been brought in. But if you want to know how much is available to you, whether you should be taking some benefit from the government that you're not doing at the moment. Certainly, sort of see them at Sullivan Dewing, and sort of they'll set you right in terms of what you're actually qualified for, and that's very, very important that people get the dollars, the assistance that they qualify for, in these current times. You can see if we've made an estimate of the total amount of spending, sort of from state, territory, and federal governments of $340 billion, over 16% of GDP. So in the bottom line, it's a lot of money. Let's have a look at sort of how some of the economic variables have changed over time. We basically went into panic buying mode in March, bought up all the toilet paper and tissue paper and the like, and you can see that March spending was up in terms of retail trade. Then we went into lockdown through April, and then we came out through May and through June. And quite amazingly, current spending is up 8.5% compared with a year ago. And that just shows that online spending has been doing very, very well. The JobKeeper package has worked as it should to be able to support people spending. The Job Seeker package has been working sort of well as well. You can see what's happened in terms of consumer confidence. Again, crunch time in terms of April, and then a rebound out of that. And unfortunately, the Victorian situation has had a bit of more of a damper on things like consumer and business confidence and business conditions. But you can see what's happened in terms of unemployment as well. That's been quite amazing that we have the whole aim of the JobKeeper and Job Seeker was to be able to protect people from going on to the ranks of unemployed. And indeed, that's worked its magic. The unemployment rate is only sitting at 7.5% at the moment. Federal Treasury don't believe that it'll get to the Reserve Bank forecast of 10%. Our view at Commonwealth Bank is that it'll get to around about 8.9% of the labour force, the unemployment rate. So anything that we can do to keep people in work is going to be important in terms of the recovery process, because the longer that people are out of work, the more likely that they're going to stay out of work as well. We need to make sure that we are weaning people off the JobKeeper and Job Seeker as we go into the new year. But of course, a lot will depend on the vaccines and also the treatment for the virus. In terms of the housing market, well, it's always about supply equals demand in terms of housing. We know that, sort of from more normal times. We can see that we have seen a softening of home prices, but by no means a crash. While demand has been constrained for new homes, supply has come back as well. So there is still a degree of nice balance, and we'll go into a bit more detail about what's happening in home prices in future slides. Now, here's some of the issues that have thrown out from the COVID-19, the coronavirus crisis. What's happened so far? A lot's going to depend, sort of down the track in terms of second waves. If we can avoid second waves and we can get it under control in terms of Victoria, that's going to be all important. So forecasting is very, very difficult in the current environment, but certainly things like the home builder package from the government, things like lower interest rates, protection in terms of mortgage payments and mortgage deferrals and business loan deferrals has been really important in terms of supporting the economy and supporting home prices. It's been a very interesting situation in terms of commercial real estate. Certainly sort of landlords are seeing a situation where they're having to cut rents rather than sort of put up rents and try and protect those people which are vulnerable in the current environment. So and certainly see any of the people at Sullivan Dewing for a little bit more information about how these new requirements sort of affect you if you're a landlord. One of the big things, of course, in terms of the economy is the closure of borders. And if you close borders, you don't get the migrants that don't coming in, you don't get the tourists coming in, you don't get the people studying sort of physically in terms of education here in Australia as well. So there have been some of the hard hit sectors, the travel, the education sector. We do know that a lot of tourists go to the CBD areas of Australia, Sydney, Melbourne, sort of Brisbane. And if you have a look at the top job seeker, sort of postcodes, you can see that Sydney 2,000, Melbourne 3,000, Brisbane 4,000 have been sort of very much high up on the list. The things like cafes and restaurants, to close down. People done in the capital cities, and if we're thinking about regions, that have been some of the hardest hit, the capital cities, compared with to some of the other parts of the economy. Those are regions that have rely more on people with lower skilled jobs. They're the ones that have been hit hardest as well. Whereas if you've got a region with higher skilled jobs, they've tended to do sort of okay in terms of the overall environment. It has always been a case of trying to get the right balance in terms of the stimulus. And I think so far so good in terms of the government, but as we know, there's a lot more to flow under the bridge before we get to the conclusion of this situation. Reducing the jobless rate will be the important thing going forward. If we're going to get a recovery in our economy, it's all about jobs. The Reserve Bank Governor said that in his testimony last Friday. It's all about jobs. It's all about creation of jobs. Somebody asked him about mortgage deferrals and what happens there. And he said, well, we won't need to defer people's mortgages if they've got a job. So it all gets down to making sure that so people stay connected with their workplace, that the economy gets back to normal, and that people can retain their employment. And we can see that unemployment rate is topping out at lower rate than in the past. It's always been a question of how we're going to react to the second wave. But I think what Victoria has shown that sort of early, swift, hard action, and same in terms of New Zealand, does work best. The debt burden is something that I'll talk about a little bit down the track in terms of the presentation. Let's have a little bit of a spotlight on New South Wales. You may have seen recently, that late July, that we put out our State of the States report. That's something that CommSec does each and every year. And at the moment, the New South Wales economy is not on top. Some of you may find that strange to believe, but if you haven't heard the results, Tasmania is out on top at the moment. And it's benefited from the fact that migration flows. It's benefited from the home building. It's benefited from the infrastructure spending there. So nice momentum happening in the Tasmanian economy. A small, very small economy, but operating well above the normal sorts of rates for the economy. Victoria, before we went into the full-blown situation with COVID, was still in second place from the ACT and then from New South Wales. For those people who like their economic data, here's a table to show you how home prices have tracked in New South Wales, the unemployment rate, and some of the other indicators as well, things like home loan growth and business conditions. I said that I'd say a little bit more about home prices, and there's Sydney home prices. We do get a daily observation of home prices from CoreLogic, and it may surprise you to know that it was only a couple of months ago, 2 months ago, that we were at record highs in terms of the home prices. So while we've come off 2.4% from those highs, you can show that we went into this crisis in pretty strong shape. The economy was in good shape. The economy was growing. We had a low or effectively a zero budget, sort of situation. So it was a small surplus for a period of time, sort of there. And we had interest rates which were coming down to support, so the economy, inflation under control, low debt levels, and also the fact that the housing market was in pretty reasonable shape across most of Australia, with the exception of probably sort of Western Australia and all the Northern Territory. Here's home prices in the across the Sydney region. You can see what they've done compared with a year ago. Now, certainly these prices have come off in the last couple of months, as I indicated in the previous chart. But Sutherland prices, according to the latest data from CoreLogic, are still 9.1% higher than sort of a year ago. So that does provide a degree of encouragement, because it shows people's the value of their asset is continuing to rise. And our view is that we're only going to see a modest deterioration of that, providing all things going well in terms of our control of COVID on the New South Wales economy. You can see in terms of home building that was already slowing before the crisis began. Indeed, sort of, you've got to go back. It's been slowing for a number of years now in terms of new building opportunities. So That will be very much the focal point as we go through the next few months and into 2021. The measures to be able to support the housing sector. Hopefully there will be more people looking at things like refurbishments of their homes, alterations and additions, renovations and the like, because that will really support the overall economy. And commercial building and things like engineering construction is going to be really important in terms of driving sort of economies as well. But you can see this is an area of focus. This is an area of risk. The fact that we do have a slowdown in terms of building activity in the Sutherland Shire, as we are seeing in many parts of Australia. And that means that people who are working in that sector need to be agile in terms of their response to the challenges and the opportunities. May need to be a little bit more cautious in terms of the pricing of invoices and in terms of the sort of work that you're taking on. Let's have a little bit more of a spotlight on small and medium-sized enterprises. I said right from the start that ACA Research have done some research on small and medium-sized enterprises. They've done these wave of reports. So you go back to April and they've done a report basically each week, so going forward, different topics, sort of covered. But here's some of the findings from the more recent report. You can see there's a link to this research in your the PowerPoint presentation that will be mailed out to you. So certainly encourage you to be able to use all the information at your disposal at the moment, to be able to get a sense about how you're likely to travel, so going forward. But interestingly, clearly, when people are working home, you don't get a good chance to be able to watch exactly what they're doing at any point in time. And 30% of businesses reporting less productivity from staff. Certainly, most businesses are reporting lower revenue. You can see how many are using loan deferrals. And you can see that most people are expecting recovery is going to take a longer period of time. In fact, that was the Reserve Bank Governor's view also when so he handed down his testimony last Friday, that it's probably going to be a little bit more, not as deep as a recession or a downturn, but it may last for a little bit longer. And of course, a lot, as I said, depends on treatment of the virus and also the vaccines. It is encouraging that 60% have the same or more employees than when they went into the crisis, but that means 40% have seen declines in terms of their employment. And indeed, as I keep on harping on about, as the Reserve Bank Governor keeps on harping about, it is all about retaining jobs. But this shows you, this table shows you that 4 sectors are actually seeing higher employment rather than lower employment compared with when we got the 100th case in March the 14th. And you can see which businesses have been hit hard. It's been the restaurants, it's been the pubs, it's been the clubs, it's been the arts and recreation areas, the sporting areas that have been sort of hard hit. Agriculture and forestry, you can see that there's been a loss of jobs there as backpackers and tourists and the like sort of leave the regional areas. And that's going to be a challenge for the agricultural sector going forward to make sure that they can get the fruit pickers, they can get the seasonal staff that they need to be able to get the food into our stores. And certainly that will be the challenge over the latter part of this year and into early next year. You can see areas like mining, manufacturing, so holding up relatively well in terms of job losses. So if you're building something, constructing something, you tend to do okay compared with if you're in a services type of business. This is a chart which is taken from that ACA research, and it gives you an idea about how concerned people are out there. And I think it's a useful sort of chart because you in the audience, clearly you've got your own views about how concerned you are. And if you believe that things are very worrying at the moment, see that you're in very, very good company. 73% of people are very concerned about business survival in terms of the current environment. I think the encouraging thing that we need to always focus on about that there is assistance measures that are being provided by federal and state governments. And if really the economy looked as though it was going to be hit in a really bad way from a prolonged period of time, the government would just continue to spend money. So it is all about doing whatever it takes to be able to support businesses and employees in this sort of a period of time. Let's have a look at some of the other messages that are coming out from the COVID environment. We've had the profit reports from a number of companies so far. We had JB Hi-Fi came out yesterday, Nick Scali, Adairs, Baby Bunting have all been reporting their results. And what it shows you is the value of having a good online presence, that if you're in a retailer in particular, these companies have done very, very well. You can see from Adairs, sort of how their online sales have gone, sort of over a period of time. So online focused delivery services have been very, very important in terms of supporting businesses. Delivery services, that may be the way that restaurants and the like, to survive in this current environment. The need for flexibility and the need to be agile has certainly been, so very important, as well. And not getting, sort of too much taken over by fear. Usually in fear that we've got some indicators that we like to look at, so the number of people who are storing $50 and $100 notes at home. Clearly, so that has been a big change. People are really worried about the situation. And we saw the last situation back there in the global financial crisis where we saw demand for notes rising. And this is one of the more, I suppose, quirkier indicators, but it's actually something that the Reserve Bank governor referred to on Friday, that this demand for notes has indeed been rising because of people's some conservatism and fear. And this is something that we need to make sure that fear doesn't overwhelm us in the current environment. Something the Reserve Bank governor is worried about when we've got borders being closed down, how long these borders are likely to stay closed down, what's the impact for the global economy as a result. So that's something that basically the doctor is still out on, sort of the verdict is still out on that. Future viruses, certainly, so there is the potential for, given, so the globalization that we've seen, the frequency of travel, so that is something to focus on. And really, the spotlight has been thrown on the care or the lack of care in many instances in terms of the aged care sector. Hopefully what this virus will provide in terms of rays of sunshine or rays of light down the track is the fact that we'll have a better approach in looking after our aged members, sort of society, because clearly the evidence to date shows that the approach has been very, very choppy. Let's change tack a little bit. We'll go into some of the financial indicators and then we'll basically finish off, and it should leave plenty of time for questions. People look at this chart and look at the wording along the side, and the first thing that they're drawn to is FOTU. What is FOTU? Well, fear of the unknown is FOTU, and really that explains what happened with the share market, what happened to the Aussie dollar through March of this year, particularly late February and into March. We just didn't know how this one was going to end. What's going to happen to companies? What's going to happen to economies? What's going to happen to people's livelihoods? Sort of how high would unemployment rise? Fortunately, governments and central banks addressed that situation very quickly. So you can see that V shape in there. Clearly, if we saw a slower response by governments and central banks, we wouldn't have seen the same degree of impact in terms of the share market. But from the high point to the low point, we've seen the 37% decline in terms of the share market, the Australian share market. The rebound to date has been 36% for the All Ordinaries and 34% for the ASX 200. So we've got another 1,000 odd points to go to get up to record highs. So we've got a little bit further to go. But you can see in terms of the Aussie dollar, that's rebounded so quite smartly, because that's really a verdict on the fact that our economy has held up very, very well. The response has been very, very good here in Australia, and the number of COVID cases have been more constrained compared with other parts of the globe. You may have seen overnight with the United States share market, the NASDAQ is at fresh record highs, and the broader measure of the market there, Standard & Poor's 500, is only a couple of points away from record highs. So that is just quite remarkable. And it just shows you the optimism and the confidence that has been portrayed for investors and for individuals and businesses more generally by the swift action by governments and as well as, sort of central banks. One of the things that have occurred, sort of in terms of supporting the share market has been the fact that interest rates are super low. So where are you going to get a return on your money? There's a lot of companies that are not supplying dividends at the moment, but the expectation is that they will down the track. The expectation also is that if you get recovery in the economy, that you'll get capital growth in terms of your share purchases as well. So that certainly supported the share market. Government stimulus, as I say, has been a super important factor. And the success with COVID has been very much important in terms of the performance of our share market as well as the performance of the Australian dollar. We've got a number of companies that are not paying dividends in this current environment. So that's very important for investors, particularly for those people sitting there close to retirement or in their retirement as well, to continue to track what the companies are saying in terms of dividends, whether sort of when they're likely to return. Some companies are continuing to pay them, but it's clearly a lot smaller than what it was in the past. Clearly, there'll be disappointment from individuals there, but remember, you want that business to be sticking around for a little while longer. You don't want to be going the way of the dinosaur. So the important thing is to be able to, for those companies that feel as though they need to hold in their cash flow at the moment, sort of if that's important to them and it's going to maintain business survival, then so be it. Interest rates, super low. How long are they going to stay low? We've got some great forward guidance from the Reserve Bank. Reserve Bank Governor said on Friday, 3 years, at least 3 years, that we're going to see these interest rates at super, so low levels. So you can see that's our expectation at Commonwealth Bank. You can see that it's not just the cash rate, which is being targeted at 0.25% now. It's the 3-year bond yield as well. That means that interest rates right the way across the yield curve are being constrained in this environment. Here's anyone who's really loves their economic forecast. Here's one for you. This comes from our Commonwealth Bank press release, our profit announcement. And indeed, sort of a nice set of tables all in the one space to show you what the expectations with things like interest rates and the unemployment rate, and the like. You can see what we're expecting for our economy, that we'll get something like a 3.6% downturn in terms of the economy in this current financial year that we're in before we get a rebound of 3.8% in the next year. So that is an expectation of V-shaped recovery. That doesn't mean to say that, sort of that will be borne out, but certainly our view is that on the basis of what we know so far, that there is a good prospects that we're doing enough to be able to get an economic recovery at the same time, get a good recovery, out in time. As I say, the big caveat with all these things is we just don't know about sort of the vaccine, sort of how that's going to be developed. Where do we go from here? We're almost at the end of the presentation, so only one more slide to go after this, and yet more forecasts. It shows you that we're expecting inflation to stay low for some time. That will keep interest rates, so low. You can see what we're expecting in terms of the share market over time. We're still going to take some time to be able to get back up to record highs. We're not of the view that we're going to see the same sort of situation of the US. I think the US perhaps has gone a little bit too quickly in terms of the share market, sort of recovery. So we do have a more cautious outlook in terms of the recovery of the Australian share market. But as I say, the caveat, as we keep on stressing, it depends on things like treatment, so the virus, treatments for the virus and also vaccine. Here's the summary. Here's the last bit. We're going to see one of the biggest contractions of the Australian economy since the Second World War. The global economy, again, you have to go back to the war years or even the Depression era to be able to see a similar situation. So we have going to see, and indeed that's to be expected when you've got a lockdown in the economy, that the economy doesn't move. That so clearly, sort of it goes into downturn rather than sort of upturn, in these sorts of periods of time. But the massive stimulus, sort of is being applied, and indeed governments around the world, central banks are basically saying, we'll do what it takes. There's a lot of people out there saying, but how are we going to pay for all this? Well, the Federal Reserve has said it, the Reserve Bank here in Australia has said it. We shouldn't be worrying about that question at the moment. What we need to be worrying about, the fact that we get back on our feet, because once we're back on our feet, then we can start to deal with the longer term situation of getting those debt levels down. The encouraging thing here in Australia is our debt levels are already low. I think I said right at the start that the gross debt in Australia is going to be expected to be around about 850 billion or 45% of GDP. This gives you a bit of perspective about other economies around the world, and indeed doesn't include this current stimulus measures that have been applied and the increase in their gross debt levels. But you can see, compared with a lot of other major economies, we had a very low debt level to begin with, and indeed servicing on that debt is going to be very, very low as well, given the interest rates are close to zero. So we are taking on more debt, but serviceability is indeed a more favourable thing when you've got super low interest rates. We are expecting a relatively quick rebound in the economy. But as I say, I mean, so there's the usual caveats about these forecasts in this sort of environment where we're really dependent on the health situation being restored rather than the economic situation changing around. As I've been stressing all the way through, that it's jobs that is the major focus of the government and also for the Reserve Bank. So if you're thinking about so any part of the economy, any part of business life, it all gets back to the job market. Clearly, confidence is going to be sort of super important as well. That people, sort of, if they are reticent about spending some money in this sort of period of time, reticent about the government continuing to support them, then that's going to make the recovery much more protracted than what we're seeing at the moment. You can see on this chart too that I basically provided a little bit of an infographic about the number of loans being deferred across Australia. So everyone's played a role in terms of supporting the economy, and indeed, sort of deferrals of loans have been sort of really important in terms of supporting people's incomes in the current environment. Once this crisis does settle down, and we do have a vaccine or treatments found, clearly there's other issues to deal with as we go later into 2020. US-China trade is still very, very important in terms of a focal point for markets at the moment. The good news overnight is that the US says that China is living up to its end of the bargain in terms of the trade deal. So for now, at least, sort of that one is on simmer rather than, sort of high heat. And of course, the US election, that small matter is going to be before us in November this year. And we've got the Democratic convention this week. So you're going to see the luminaries like President Obama, sort of trumping up, sort of in front of the cameras. That is all from me, which I'll hand it back to Jenny.
Fantastic. Thank you so much, Craig. That was some very good insights for us there. And now, if I can ask everybody to pop their questions in the chat box. We've got a few coming through, but I think a few of the key points for me out of that, Craig, and a very important economic update for us was the fact that spending is up so much, and Queensland up 20%. I think New South Wales, we might need to lift our game a little bit and go out and spend our job seeker and our job keeper to make sure we're keeping up with the Queenslanders. We can't let that interstate rivalry get away from us, can we? Debt level at 45% of GDP, which sounds to us all that that's quite a high debt level. But I think your point is really important that that with interest rates so low, the serviceability on that debt is hopefully more manageable than would otherwise be. What would you say in usual economic circumstances, Craig? What is a normal debt level as a percentage of GDP for Australia?
It does depend, as you say, in terms of the interest rate, level of debt. So something in the order of 20, 30%, sort of GDP is something that we've been, sort of look regularly over time. I've got to do a little bit more research. I'm going through the history books at the moment to get my economic data, things like budget balances and GDP. And indeed, there is some data series on debt to GDP ratios, over time. We know in the war years, the First World War and the Second World War, that we had a very significant blowout in terms of debt, more than 100%, sort of GDP. But once we were getting back into normal, the war had over and we were functioning more normally, then we were starting to generate the economic growth that was required. And of course, there was fast economic growth through the late 40s and the early 50s. And indeed, we want to, so that taxation revenue, that spending, sort of revenue, keep government spending down, get that revenue, so coming through. Then we can start to get the budget back into balance and, sort of get our debt, levels down. But certainly, yes, we've had a modest level of debt, sort of over time. Certainly nothing in the region of what places like Italy and Japan, sort of have recorded, so over their time.
Yeah, absolutely, and that sort of leads on onto another point. So we know across the tax system that we are sure to see some tax changes to help Australia pay for some of these stimulus packages. So I've mentioned to clients many times in the past we've had the budget repair levy, we've had fire levies, we've had flood levies. So I can certainly see a COVID levy coming upon us at some point in the future. Do you have any thoughts on that?
It is an interesting one, and certainly that is a lot of the discussion about how the debt is going to be reduced over time, how we get the budget back into balance. The current government, sort of is of the view that what it wants to do is not to introduce any new levies or taxes, that it's trying to generate strong economic growth in its own right, generate, sort of the strength in terms of the economy, so provide stimulatory, sort of spending to get that momentum happening in terms of the economy. Once it's then able to run on its own 2 feet, to start, withdrawing some of the stimulus, some of the support, sort of payments, and then, sort of let the momentum, work on its own right. When you look back at, sort of the time of Howard and Costello, when they came into power, what they basically did was a couple of changes initially when they came into power, and then they were able to ride really sustained strong period of economic growth. And that's why they were able to push the budget back into surplus and, to start repaying, sort of debt. So I think the government would like to emulate what Costello and Howard did, sort of back in, sort of the late 90s, sort of early 2000s.
Yeah. It'll be very interesting to see how it plays out. Let me ask you a couple of questions from our audience today. So first question from Ross. Hi Ross, how are you? Who will take China's place as our major import and export provider?
Well, I think China's going to be there for a little while longer. Certainly India, when we're thinking about, sort of exports and imports too, I suppose what we need to be thinking about in the traditional sense, we've always looked at things that we dig out of the ground or grow in terms of the agricultural sector. So agriculture and mining has been important about thinking about, so that. But of course, we're getting a lot more income from tourism, from education, so over time. So the Asia region generally, including India, is going to provide important contributions to that. China certainly providing that contribution in terms of tourism and education as well. So I think China is going to stay there for a little while longer. India is probably the natural successor. Indonesia probably not too far behind as well. What we're hoping is that Indonesia, given the size of its population, can emulate the same sort of things that China has done before, and Korea's and Hong Kong's and Singapore's get down on that industrialization, sort of bandwagon.
Yeah, which is quite interesting because a point that I speak to clients about regularly is make sure they don't have one major client. They are or customer. They need to spread their business risk by having multiple customers. So from Australia's point of view, we certainly need multiple customers as well, not just China. So possibly we're spreading our risk a little bit by bringing on possibly India a little bit more, Asia a little bit more.
Particularly if you think of something like iron ore. So iron ore is our biggest export by a country mile. And then there's a big gap to things like natural gas, coal. If it was a situation where China and other parts of the world said, no, we don't want your iron ore anymore, that would have a very big impact in terms of the broader Australian economy, and particularly in terms of the West Australian economy. So we have to continue to focus our attention in other parts of their economy, make sure that all parts of the economy are growing over time, and continuing to look at our trading relationship, because we've got something like getting up to 35% thereabouts of exports and imports with China. So it has got a significantly high share, far bigger than anything that we had with Japan. And really, so getting back to the 1800s, so the share of relationship that we had with the UK. So you're right, sort of any smart business wouldn't be exposing themselves to one particular sort of good or service or one particular customer.
Yeah, that's it. Absolutely. Moving more to an observation from Angela. Thank you, Angela. We feel that if Sutherland Shire Council did not take 15 months for approval on a residential building application, there would be a housing boom in the Sutherland Shire. Let's see how that plays out as we try to recover in the economy. Let me grab a couple of more of these questions for you.
Well, certainly, I think those sorts of things are really important because, and it's something that the local members, so the federal members as well as the state, it needs to be expressed to. You have got a very important federal member, sort of down there, sort of.
And we bump into him on many of the occasion in the local shops, so we might have to have a word.
Yes, have a word.
That's right, have a word. Barry has asked the question: the Australian dollar versus the US has rebounded strongly in recent weeks. Why is that?
One is a degree of uncertainty about the United States, about where it's going, because they're coming out of lockdown and it's not a very a seamless process that's going through. Some states are having to go back into lockdown, so uncertainty about the United States. The other thing that's happening as well is that overall we've got economies that are starting to get back to normal. Indeed, there are fits and starts, but there's a little bit more optimism globally now. We do know that the US is seen as somewhat, US dollar is seen as somewhat of a safe haven. Same as the Japanese yen. We're seeing those two currencies weaken, euro and the Australian dollar. So Australia is really important, or the Australian dollar, what's really important for the Australian dollar is a good outlook for the global economy, because we've got to sell our goods and services to the rest of the world. If they're growing and the outlook's looking some more promising, indeed, then we're likely to see the Australian dollar rise over time. So I think it's been our good control of COVID cases here in Australia, the fact that our economy is holding up quite nicely, and also some improvement in the global situation, meaning that a commodity producer like Australia has had a bit of a leg up, sort of in terms of that optimism.
Yeah, that's it. Okay, a little bit of a technical question here for you from Richard. Money printing is occurring at unprecedented rates to fund the government expenditure. Consequently, what sectors of the economy do you see inflation or hyperflation occurring? And in what sectors do you see deflation occurring?
It is an interesting situation at the moment that given the amount of stimulus that's being applied, ordinarily, so what you would see in terms of traditional economic theory is too much money chasing too few goods basically so drives up so the rate of prices and inflation. So I don't think we can be hard and fast in particular sort of areas that are going to see deflation and inflation. There's one that emerged overnight in the United States, and we might see it here in Australia. We do know we've got the home builder scheme here in Australia, and indeed that's the hope is that what we'll see is greater construction. In the United States, super low interest rates and support for the housing market as well is driving construction and optimism about the housing market in the United States. That's actually seeing lumber prices rise significantly. So we've had a degree of inflation happening in terms of lumber. So here in Australia, it is hard to find the areas where we're seeing super high levels of prices or sort of prices falling in sort of big way. But clearly when demand sort of exceeds supply, things like toilet paper and tissue paper, you don't have discounting of those sorts of items. And we did see some higher prices for some of those sorts of items through March and April. So we have seen a little bit more in terms of supermarket prices rising rather than falling. That's because there doesn't need to be the same sort of discounting in the current environment, given that there's significant demand for those staple type of goods.
Absolutely. And taking you back to interest rates for a minute, you made reference to the fact that that it's predicted that interest rates will be low for possibly another 3 years. Have you got any thoughts on whether people should be fixing rates or whether they should be leaving their rates as variable and just riding out these low rates?
It always gets down to a personal preference, I think, in terms of fixed versus variable. If you're concerned about your job, and indeed more people are concerned about their job in the current environment, concerned about your job, wage growth over time, so the outlook for employment, you want to probably make sure in terms of that you've got so as low as possible in terms of interest rates. So a degree of fixed and variable may get the total loan value to come down, and you'll have a degree of certainty come in the overall environment. There's not the great focus in terms of going fixed in the current environment, because you've got 3 years where interest rates are effectively going to be held steady. So I wouldn't be sort of too concerned from that level.
Yeah, absolutely. Yeah.
If you are concerned about the outlook for your job and your income, clearly sort of fixed, a more greater component of fixed rather than variable would be important in terms of the cocktail of the loan.
And so, certainly what we're seeing with a lot of clients with the 150K immediate asset write-off, there's a lot of clients actually going into finance for assets at the minute and locking in low rates into those finance contracts, which I think is very beneficial for them to get the tax deduction as well as the low rate. Absolutely. I've got Richard come up with a question for you. The International Monetary Fund has released a white paper a couple of years ago suggesting that governments implement deep negative interest rates. What are your thoughts on this topic and the effects it would have on the Australian economy if implemented? So that's the IMF and deep negative interest rates.
Yeah, no, this is something that the Reserve Bank governor has been constantly asked about, the value of negative interest rates. And indeed, there's theories, there's studies that have been done by all sorts of manner of institutions around the place. The bottom line is, do negative interest rates as they're currently applied in places like Europe and Japan work? Well, we can't focus on those two economies and say they've been a riveting success. Far from the case. So those two economies are still finding it very, very tough going. And they've had negative interest rates for some time. The United States Federal Reserve has ruled it out. Ourselves here in Australia, the Reserve Bank governor says, I see it as extraordinarily unlikely that we would go down that path. And he's taking that view because he looks at the impact on the economy, weighs the benefits from the disadvantages, or the advantages and the disadvantages. And he's basically saying he can see more risk for the financial system. Clearly, if you're a bank that gets most of your deposits, internally, you're probably at a disservice to those banks which are getting their money on the wholesale market. So it causes distortions in the banking system, and indeed, it actually may cause people to save more because they're getting effectively negative interest rates. We think of it as you've got $100 today and $95 in 12 months' time when you have a look at your bank account. And that effectively is how negative interest rates work. So if you're going to have less money down the track, you may need to save more, now, so that you've got, that desired level of return, is higher down the track. And indeed, that's a negative situation. People are actually saving more rather than spending more. So it's one of the disadvantages of the overall system. I share the Reserve Bank governor's view that there's probably more negatives rather than positives associated with it.
Yeah, absolutely. I share the same view, I must say. You made a comment earlier about the early release of super and where that money's being spent, and it's quite interesting. We had a lot of inquiries through our client base about that early on, and then most of them actually didn't end up taking that early release. Different possibly to some other sectors of the economy, because that scheme seems to have been taken up across a fairly broad approach. What are your thoughts there? Do you think that should have been one of the stimulus packages put out?
Well, it is our money. So at the end of the day, it is our money which is, you know, sitting there. And if it's being utilised for an important and useful purpose, you know, so I can see the advantages of that. People say, look, you know, sort of, I don't want to have to sell my house, but, you know, sort of, I haven't got any income coming through. I'm concerned about where my money is going to come from. I know I've got some super locked away. Why don't I just get access into some of that superannuation? So you can understand that people, you know, sort of finding it very much cash strapped. You can see the advantages of that coming through. But the statistics seem to suggest that 40% of the people that, you know, so withdrawing money to the superannuation really don't need that.
Yeah.
That's what they're saying for it. And indeed, a lot of that money is going on non-essential type of spending, you know, sort of as well. So certainly it is people's money.
I had a number of questions from children of clients actually that were talking about accessing some of their super to purchase cars or pay off car loans or things like that. So people in their early 20s.
I think that's an important point. You know, so if you're in your 20s and you want to pay down some of your debt, you know, so clearly that you're thinking logically about that. You're thinking, you know, sort of productively, you know, sort of about that. So you've got plenty of time to rebuild those savings, you know, over time. But if you're in your 40s and 50s and you're down the same sort of road, you know, sort of clearly there's risk for you because, you know, by the time that you do get to the retirement, you know, sort of 65 or 67, you know, sort of, you know, the extra dollars may not be as forthcoming from the government as they are now.
That's right. That's right. Interesting times, certainly. Well, that brings us to about 10 o'clock this morning. So I'm just conscious of our time. So I would say thank you, Craig, very much for joining us this morning. Thank you, Stuart, also for joining us. We certainly have gained some valuable insights and certainly very important things for all of our clients to hear. So we, as mentioned, we'll send out a copy to everybody of the video of this morning, as well as the presentation slides. So if there are any further questions, just please come to us at Sullivan Dewing and we're more than happy to answer them for you. And thank you once again, Craig. That's been fantastic. Thank you.
No problem at all. Thank you all for attending today.
Thank you.
Thank you.